Little technical difficulties here.
Well, I think I'm going a little too fast here, guys. I'm sorry.
Yep, you might have to back arrow.
Yeah, that's what I'm trying to
Okay.
figure.
Sorry about that, Angie.
No problem.
Interesting. There we go. Okay, well, hello everyone. My name is Hawaswari, and I am a member advisor with SECU. And as Angela mentioned earlier, joining me today is our amazing mortgage expert, Derek Rim, who is going to share some insider tips and tricks to help you on your home buying journey. And also my wonderful manager, Kelly, who is here to support us and also to answer all your questions in the chat box. So please feel free to drop any questions that you have throughout the session, the chat box, and we will be glad to answer them. We are super excited to spend time with you guys today, and we really appreciate you taking your time to join us today as well. And before I move into the presentation, I just wanted to give you a little background on CQ. So CQ was founded in 1951 for state employees as a way of thanking you guys for everything that you do for the Marylanders. We are the largest credit union in the state of Maryland. We have 23 branches. We also have a virtual financial center that is open from 8 a.m. to 8 p.m. For your own convenience. And we have over 50,000 ATM across the state of Maryland that you can use for free. And these are ATMs that are in 7-Eleven, on Costco, Target, Speedway, and Walgreens. These are all free for you to use. We also have we offer all product that other traditional banks offer as well. The difference between the credit union and the bank is that we do not have shareholders. So because of that, we are owned by our members, which allow us to offer you guys a lower interest rate when it comes to loans and a higher interest rate when it comes to deposit product. So that's just a little bit about CQ. And now let's move to the fun part where we are here for today. Give me one moment. I'm just gonna go off camera. This is just to make it easier for us with the presentation.
Yeah, sorry about that.
Give me one moment.
How about, is it easier if I work the slides for you?
Yes, I think it's
Okay.
okay. Easier.
Okay.
I'm not sure
one
what is
moment.
going on today.
Okay, that's okay. Just let me know. So we're ready for the next slide.
Yes. Oh no, go back to the first one. Actually, I'm sorry. There you go. You can stay right here. Okay. And here are some of the things that we'll be learning together today. One of them being understanding what a credit score is, learning how to build and protect your credit, exploring different types of credit, and discovering the tools of paying your debt wisely. So now we can go to the next slide, please. Okay. So let's start with the borrowing 101. So when it comes to borrowing, it can help you build your credit. It can help you manage emergencies or even achieving your financial goal, but only if you do it properly. And some common options for borrowing are your line of credit, which is like your home equity line of credit, which helps you consolidate all your loans into one lower monthly payment. And they often also have a lower interest rate compared to most loans. And then the second option will be your credit cards. And these are good for building credit history, earning reward points like cashback or travel point, which can be redeemed for your future purchases. And the other option is also financing large purchases, which features like 0% introductory APRs, because most credit cards offer those promotions like we have right now going on with SECU. And then it's also convenience by being safer than carrying a larger amount of cash in your hands as well. And these are all ideal for those who can spend responsibly and pay their balance in full each month to avoid paying interest on their credit cards. Next slide, please. Okay. So if you all can put in the chat for me what word or feeling comes into your mind when you hear the word credit. So I'm gonna give you a little bit of time just to see if anyone wants to throw out any answer out there, and then we can go over this slide.
So great.
Okay. So these are all great questions. I mean, great answers. So thank you all so much for those answers. So when we think of getting a loan, sometimes it can be a really overwhelming. You can be curious or even being having the fear of being denied. But let's normalize all these options, and these emotions, as this is also something that we can learn and improve over time. So all these are great, great answers, but just, let's learn to normalize them because we can learn and improve these over time. Next slide, please. Okay, so now let's talk about why your credit matters. So most of the time we may see our credit score as just a number, but I want to remind you all that our credit score affect our ability to do a lot of things. And one of those things can be renting an apartment, can be applying for a loan, can be opening an account, and even getting a job. So maintaining a good score is crucial. And we will talk more about this into the next slide as well. Okay. Okay, so as I mentioned on the previous slide, your credit score affects more than just applying for a loan. And I would then give you more details about what I mean by that. So let's start by renting an apartment. Your landlord will check your credit to determine if you are an asset or a liability to them. So what I mean by that is, are you an asset, which is someone that will be able to pay their rent in full every month and on time? Or are you going to be a liability, which is someone that they will have to go through court, to go through eviction, which will cost them money? No landlord wants that, okay? And then the other thing why they will check for your credit is also helping the landlord determine your security deposit. A person with a high credit score will definitely have a lower security deposit compared to one with a lower score, which will end up paying a higher security deposit. So now let's look at your student loans as well. Although the federal government does not check credit for FAFSA or like most student loans, but they do check your credit for certain federal loan and all private student loans. So keep that in mind as well. And then now let's look at your car payment. The lenders always review your credit to determine your monthly payment. They also review it to determine your interest rate and even determine whether you are someone that will get approved or not. So my recommendation will always be to start with your local credit union or your bank for all your car purchases before going to the dealership. This is because the dealership works with several banks that they use as their finance company. So when they pull your credit, it's like they are throwing it in the wind for all banks to also do their pull on your credit and see who offers you the best rate. So throughout this process, your credit is going through a hard inquiry, which is going to then affect you by bringing your credit down. So keep in mind when purchasing a car, always start with your local credit union or your bank. The next thing that I will talk about is the job application. So right now, most jobs review your credit score before offering you a position. And I will take an example of myself. When I applied for this job and I did my interview before SECU offered me this position, I went through a background check and a credit check. And this is because SECU had to make sure that I am responsible with my personal finances before I come out here giving advice to our members, okay? And being able to, they want to make sure that I am able to give you guys good advices good advices before giving me the job. Next slide, please. Okay, so now let's look at what is a credit score. So your credit score is a 3-digit number that predicts your credit and spending behavior. So this number ranges from 300 to 850, okay? So an example is a person with a 600 or less credit score will pay more interest on loans compared to one with 700 credit score. And I will talk about this more in the next slide as well. Okay, so now let's look at what impacts your credit score. This category is divided into 5, right? Okay, so now let's start with your payment history. Your payment history takes 35% of your credit score. And this is because when you apply for a loan, creditors review how you are making your payment, meaning are you paying on your due date? Are you paying late fees? Or are you paying before your due date? Okay. And also, this also helps creditors determine how or if you are able to pay them back when they give you a loan. So when we apply for new loans, they always want to make sure that you are able to pay them back before they give you the loan. So that's the reason why they review your payment history. And that plays a greater role. As you can see, it's actually the highest category. It's 35% of your credit. And now let's look at your credit utilization. That affects 30% of your credit score. So let's take credit cards, for example, okay? It's recommended that you use 30% or below of your balance. And we recommend this because this will help you pay faster and also avoid you from carrying over balances on credit cards that have high interest rate. Because if you have a credit card that is charging you 25 or 30% of interest rate, and you are carrying balance over every month, then you will be making payment, but your payment mostly will be going towards the interest instead of the principal balance that you have. So we always advise members to use 30% or below of their credit balance. And now let's look into the length of credit, which is 15% of your credit score. Okay. When you apply for a new loan, creditors review how long your credit have been established, including the age of your oldest account, the age of the newest account, and average of all your accounts. So having relatively long credit history and not opening many new accounts is seen as a low credit risk, which is great for your score and increase your chances for even being approved. Because if they're reviewing your credit and see that you have a long credit history that is in good standing, and that will also increase your chances of getting approved. So the tip that I can give on that is never close your old credit, because this is like you're erasing your credit history. And if you erase your credit history, that is going to bring your credit down. So try to hold on to your oldest cards, have them in good standing as well. And now let's look at your credit mix, which impact 10% of your score. So having a mixture of credit types of the different type of credit may increase your credit score. And this also shows lenders that you are able to handle multiple type of loan. So what I mean by credit mix is when they look at your credit report, they want to see that you have a credit card, you have a car payment, and then you have a mortgage or you have a personal loan. So that's what we mean by mixture of credit. But it's also very important to only apply for different type of credit when you need it. If you don't need it, then don't apply for it. I just want to throw that out there. Especially since this category is only a small percentage of your credit score. So keep that in mind. Now let's look at the new inquiries. When applying for a new loan, lenders look at how many accounts you've recently opened. So within the last 12 months, for example, they will look at how many cards or how many loans you've applied for. Whether you've been rate shopping for a single loan or applying for multiple new line of credit. So we may have, let's say, 3-4 different credit cards right now that we are trying to apply for a personal loan to consolidate all that into one. So if you apply with SECU, for example, and go to Bank of America and apply for the same type of loan, then that is different from if you apply with SECU and then go to Bank of America and apply for a car loan instead of the same personal loan that you apply for with SECU. So they look at all those new accounts that you're applying for. And like I said, if you don't need it, don't apply for new because this definitely it's not a huge percentage on your credit report, but still keep in mind that it's important to keep that loan. Opening several new credit accounts in a short period of time, the creditors would see that as a risk or a risky lender, so they may be skeptical to giving you these loans. And I also know that, let's say sometimes we go to Marshalls, they offer us these credit cards and then say, if you apply for it today, you will get 10% off. But you may be able to get that 10% off right there and then. But if you are planning on buying a home anytime soon, I will keep my new inquiries very, very low, or maybe don't even apply for one. Okay. Next slide, please. Okay. So I will also let you all drop in the chat box if you know where to check your credit score. I'll give you some time before I give out the answer. Does anyone know where to find your credit scores? Okay, I'm gonna go through these chats right here. Okay, TransUnion, okay, annual credit report. Okay. So what's the Credit Karma? Okay, Credit Karma you can see your score on Credit Karma, but just keep in mind that Credit Karma does not give you your accurate number. So it could be something around that, lower than that, or more than that. But one of the things that I want to say is FICO all banks do use FICO. So if you go on your bank app, you will definitely see your credit score over there. And you can also check on the major 3 credit bureaus, which are Experian, Equifax, and TransUnion. Keep in mind also that different lenders uses different score. So SECU, for example, we use Equifax. So a different bank may use TransUnion and Experian. It all depends. So keep that in mind as well. Next slide, please. Okay. And then this is also another resources to checking your credit score. So as a Maryland resident, you are entitled to 1 free report per week. Apparently this used to be 1 year, but they did a recent change. It's now 1 free report per week at each credit bureau. But when you're doing it on annual credit report, make sure it's .com and not .gov to get the result that you're looking for. And next slide, please. Okay, so here is a breakdown of how lenders view your score. If your score is less than 579, then that is considered poor. If your score is between 580 to 669, that's considered fair. If your score is between 670 to 739, then that is considered good. If your score is between 740 to 799, then your score is considered very good. And if you are 800 plus, then you are excellent. And I know we all want to be in that 800 plus. So just keeping that in mind as well. And also, again, also keep in mind that different lenders may use different model to check your score as well. There's also the Vantage versus the FICO score. And your Vantage score is a score that is created by the 3 major credit bureaus, Experian, Equifax, and TransUnion, as an alternative to the FICO score to assess your credit worthiness. So some lenders may be using the Vantage score instead of your FICO score. Next slide, please. Okay. Now let's look at the perfect example of someone with a high credit score and someone with a lower credit score. Okay. Let's say you have a credit score of 600, and then someone with a credit score of 800 comes into the same bank at the same time to get the same loan, a car loan for 30,000, for example. The person with the 800 may end up getting the interest rate, the annual percentage rate, which is also known as APR of 3%, and their monthly payment will be $539.06. And they are only paying $2,343.64 in interest. But if you're one with 600 credit score, even though you're applying for the same loan, same amount, you may end up with a 10% interest rate. Your monthly payment will be higher, which is going to be $637.41. And your interest rate is going to be $8,244.68. That is a huge difference. That's nearly $6,000 for the same car, but just based on your credit score. Okay. And I know most of the time we may get upset when we go to credit unions to get a loan and we get denied, but we are in a hurry of getting the car. Okay. When we pull your credit as credit unions, when we pull your credit, we look at your debt to income ratio, especially SECU. I know SECU is really big on that. When we look at your debt to income ratio and we see that it's too high, SECU usually don't want to be the one putting you in more debt. So they rather deny your loan. But the good thing is we also don't just send you away after denying your loan. We advise you on how to work on your credit and improve to then reapply later for your better once your score gets better. On the other hand, when you go to the dealership just wants to give you a car and get their interest, okay? And that is why they mostly just check for your income, proof of insurance, and your mortgage or rent payment. And they send you away with a car. And when that happens, you are now even more debt or possibly even struggling to pay back the car payment. And that's how most people end up losing their cars as well. So keep in mind, we may deny you at that time, but it is for your own benefit. Okay. Next slide, please. Okay. So these are some of the tips for using credit card responsibly. What I will always say is, please use your credit card only when you need it. If you don't need it, don't use it. If you know that you will be able to pay your balance at the end of the month in full, or at least pay the minimum payment, then yeah, go ahead and do so. But if not, don't use your credit card. Okay. And if possible, if you're able to pay your balance, everything on time, on in full, that is even better. Okay. And then again, I'll repeat this. I cannot stress this enough. Make sure you stay below 30% or at least use only 30% of your credit card. And you also want to pay attention to the APR, which is the annual percentage rate. Most credit card, my advice is always shop for the best rate. Okay, because different banks may have different type of credit cards and the interest rate varies. So if you also look at the ones with annual fees as well. You don't want to get a credit card that has an annual fee because then you end up paying more money that you may even use on the card. So look out for those APRs. And then I know here it says close all cards, but don't close your old cards as I mentioned in the previous slides. Closing your old cards is erasing your credit history. And when you do that, that brings down your credit. And so don't close your credit card. And one thing I will also add that is not on the slide is avoid getting the store cards. As I mentioned earlier, those store cards will make you do unnecessary shopping that you may not even need. So keep that in mind as well. Next slide, please. Thank you. And then also, if you can type in the chat box as well, one thing that you could tweak today to help your credit score, I will give you some time. And then before telling you guys, moving on the next slide, I'm sorry. If you can tell me one thing that you can tweak today to help with your credit score. Let me go ahead. Staying below 30%. That is really great. Pay bills on time. Great. Okay. These are all great answers. And thank you guys so much for keeping the chat alive. I really appreciate this. Thank you so much. So now let's look at the common credit pitfalls as well. Okay. Give me one moment. Okay, so if you look at the list that is on the screen right now, what are some of the things that is tempting for you? Are you making only minimum payment and not paying anything extra towards your principal? Are you maxing out your credit cards, or are you avoiding credit or in total? By the way, I hear people, well, this is mostly young generation, like my generation. I hear a lot of people say this, oh, I wouldn't just apply for credit just because I don't want to be in debt. And I always laugh and ask them, well, what if you're ready to buy your first car or your first home and you don't have no credit established? So how are lenders going to trust you with that amount of money? And most of them just say, oh, I would just pay cash. And then when I ask them, well, you can do that, but you're always not going to have cash to pay for everything. Okay. And you definitely don't want to use all your savings every time you want to buy something, because what if emergency comes up? And then they go, oh, I never thought about it that way. So avoiding credit audit total is not a good idea at all. And then are you one that ignore APR just because, you want to just get a card this time? So you're like, oh, I'm just going to worry about the APR later on. So my advice for if you fall for one of these, my advice is always set up an automatic payment for at least your monthly payment to avoid missing your payment and paying late fees. Because some of those late fees may be like $40 a month. And that quickly add up. So setting up an automatic payment for at least your monthly payment will avoid you from paying those late fees. Next slide, please. Okay. And so your next slide will be like, what would you tell your younger self about credit? I'm also going to give you guys like few minutes just to respond to that. And then I can tell you what I will tell my younger self. By the way, I'm still young. I'm still a baby. I'm just gonna give you all a few minutes just to tell me what will you tell your younger self about credit. Pay your credit card, okay. Use it only when you need it wisely. That's definitely great. To share your card with anyone or add anyone. Oh yeah, that is definitely a big one. You don't want to do that. If not needed, leave it alone. Great, okay. Okay. These are all great answers. Again, I really appreciate all your answers in the chat, definitely. And what I would tell my younger self is it's never too late to start, okay? Start building as early as possible, but it's never too late. And definitely pay at least your monthly payment because you don't want to pay those late fees again. And then check for the interest rate. If, for example, SECU is offering you a credit card for 14% and a different bank is offering you 20 some percent, you definitely want to shop for the best rate. And also check for those annual fees, because most banks now give you credit cards without annual fees. So if you can avoid that, then definitely great. Next slide, please. Okay, so now let's go over the type of credit cards type of credits that we have. So credit is divided into like three. We have revolving credit, which include your credit cards and your line of credit. We have installment credit that consists of your auto loans, your mortgages, and your student loans. And there's also service credit that include your utility bills, your cell phone bills that are paid monthly. Most of us know people that cannot put their bills under their own name because they may have neglected their payments before, and now they're in collection and cannot have their bills under their name. That's something that you don't want to do. So it's very important to keep up with at least your monthly payment, because you don't want to have to ask a family member or friend to have your utility under their name. Next slide, please. Okay, so now let's look at the interest rate and fees. So credit cards now, the rate ranges from 15.25 to maybe 30%, okay? And then there's also an annual percent, well, the APR is the annual percentage rate. And then you have loans and mortgages that vary. So always shop for the best deal that is good for you. Avoid late payment. You don't want to keep paying $40 every month. Avoid overdraft fees. Definitely don't want to give away money that we may not have. And also annual fees. So look at all this stuff. These are all things that can be avoided. So we really don't have to keep paying bank stays when you don't have to. Next slide, please. Okay. So here is two options for debt repayment strategies, right? So there's the snowball method, and the snowball method usually encourages you to pay off your smallest debt first and then move to the next step. By doing this, it usually provides quick wins and motivation, and then you can attack the larger ones. And it also gives you a peace of mind, because if you have a credit card that is $700 and you have a loan that is maybe $2,000, and now you paid off the 700 credit card, you don't have to worry about that anymore. You only have to attack now the big one. And the second option is the avalanche method. On the other hand, this one encourages you to pay off loans with higher interest rate. So you may have a credit card that you don't owe a lot on it, but if you're paying a high interest on that, you definitely want to go ahead and pay that off. This is best for your long-term savings, and it also saves you money in the long run. But as always, look at these two options and choose which one works best for you. Next slide, please. Thank you. So looking at the checklist on the list right now, can you say yes to these things? I'll give you all some time to review it and let me know if you can say yes to any of these. Okay. So if the answer to these is no, please reach out to your trusted banker or even myself so we can have a one-on-one conversation to get you where you need to be. Okay. Me says 1 and 2. Yes, yes, yes. Great. I see a lot of yeses. That's definitely great. I see a lot of yeses. But if any of these the answer is no, please reach out to your trusted banker or to myself so we can have a one-on-one conversation, and then we can get you to where you need to be. Next slide. Okay. This picture always makes me laugh. So let's say you are juggling payments between cards and loans right now, or you're feeling anxious and checking your balance every day, and you're like, oh my God, I still have a lot on this card to pay, or I still have a loan on this card this loan to pay. If you're using credit card to cover everyday needs, or you are only able to make your minimum payment, just know that it's time to ask for help. So please, 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 again, you are not alone in this. And as I mentioned in the previous slide, your local credit union have a lot of resources to help you get out of this. So if you say yes to any of these, please reach out to us and we can help you. Next slide, please. Okay. So this is another statistic. So it says nearly 3 out of 4 Americans say they feel stressed about money. I told my manager that I feel like this number is too small. I feel like most of us are struggling with this. And 43% of U.S. adults carry credit card debt month to month. That is a huge percentage. Next step, please. Okay, so here is also a quick step to help you understand your loan better. One way to help you understand your loan is by listing your debt to have a visual understanding. When I say listing your debt, so you list, let's say you have a Discover credit card or a Discover loan. Write down the name of the company, the amount, the interest rate, and the minimum payment that you're paying every day. Because if you do this for all your loans, you have the visual of what you're paying, and then you can better understand your loan. And also, the other one would be choosing one plan that works best for you. As I explained the two options, the snowball is paying small loan first, and then the avalanche is paying one with the highest interest rate. Choose the best option that works for you. And then also setting up automatic payment to never miss one and protect your credit score, because missing those, they will report it to your credit report. And if that's shown on your credit report, that is also something that can ding you. And most lenders also have hardship programs, so you can call and ask if they have that and if that's something that you are able to enroll for. And then also contact nonprofit credit unions like Green Part, to see if there's any option for you or if there's anything that they can help you with. So these are just, a few things to do to help you understand your loan better and also help you get out of debt. Next slide, please. And we also put in some SECU support that we have for you, the resources that we have to help you to help you reach your financial goals as well. We have free score tools to help monitor and improve your score. We also have credit building opportunities like starter visas or secure visas and many more stuff that we do have that can help you get out of debt. We also have personal loans that you can consolidate your loan into one and have just one monthly payment and lower interest rate. And then there's an online budgeting tool and goal setter as well. And of course, you always have a free financial wellness checkup if you decide to come into any of our branches or visit our virtual financial center. These are just few things that we put, but there's many more resources out there. Next slide, please. Okay, so this is something that I will recommend that we do. You can do it today, tomorrow, anytime, but this is definitely one of the things that I'll recommend you do in the next 7 days. It's by checking your credit with all the credit bureaus, making one extra payment towards your principal, or choose your smallest credit card to pay on it today, or even better, again, schedule an appointment with any of our SECU advisors to see how we can help you. Okay. Well, thank you all so much for your attention. I hope you enjoyed these slides as much as I did, and hopefully learned something new. And with that, I will turn it over to Derek, but I will start answering some of your questions in the chat as well.
Thank you, Hawa. Appreciate the introduction. Hello, everyone. My name is Derek Ream. I am the mortgage loan officer here at SECU. I'm going to talk a little bit about the home loan process and what to expect along the way. As you prepare for key life events, buying a home may be on the top of your list. Whether it's your first home, a dream home, or a smart investment, the home buying experience can be both rewarding and complex. In this next section, we'll briefly explore some key aspects of home buying and what to expect along the way. One of the most important steps in buying a home is finding the right mortgage product. I'm going to go over a couple options that are offered and explain the difference between each. Conventional financing is available for both first-time home buyers and repeat buyers. Down payments as low as 5%, but there will be no private mortgage insurance or PMI when you put down 20% or more. To qualify for conventional financing, normally good credit and a down payment saved up is required. Home Ready is a low down payment loan program of 3% minimum designed to help creditworthy, low to moderate income borrowers achieve home ownership. Home Ready has competitive interest rates along with a reduced PMI or private mortgage insurance, which is a great option to make home ownership more accessible and affordable. Now, FHA, something everyone's probably heard of a lot of, is an ideal for those with limited financial resources. Lower credit scores, sometimes as low as 575, and higher debt to income ratios are allowed. Rates are usually anywhere between 1/4 to 3/8 lower than conventional, but unfortunately does come with monthly and upfront mortgage insurance that does last the life of the loan. There are two different loan types that are available in conventional and FHA financing. These are fixed rates and adjustable rate mortgages, otherwise known as ARMs. Fixed rate mortgages have an interest rate that stays the same for the entire loan term, whether it's 10, 15, 20, or 30 years, which provides you with predictable and manageable monthly payments. Adjustable rates have interest rates that can change periodically based on the market conditions. Rates start much lower than the fixed, usually anywhere between 0.5 to 3/4 cents lower, and they're locked in at a rate anywhere between 3, 5, 7, or 10 years, and can adjust up or down depending on the market after the fixed rate period is up. Next slide, please. So home buying and how to prepare for the purchase. So the first step in preparing to buy a home is check your credit score. Know what your credit score is currently at. A higher credit score will help when buying a home by qualifying you for a lower interest rate, better loan terms, and a higher borrowing limit. Higher credit scores show the lender that you are a low-risk buyer, making it easier to get approved for a mortgage. Now, the second step in preparing to buy a home is saving for a down payment. Higher down payment can help reduce or eliminate the PMI and lower your total overall mortgage payment. As I said earlier, 20% down is ideal to eliminate the PMI, but we do offer products with little to no money down. Now, outside of the mortgage down payment, you also need additional savings to cover any closing costs. Closing costs can range anywhere between 2 and 5% of the sales price and fluctuates depending on the location of the home. Last, when saving for a home, please consider moving expenses that can range anywhere between $2,000 and $5,000. Now, the last step is to get pre-approved for a mortgage. In this step, you will need your pay stubs, at least 1 month's worth, W-2s, the last 2 years, and bank statements, usually 2 months. Pre-approval show the sellers that you are a serious buyer. A lot of times, realtors will not show you a home unless you have a pre-approval letter. This step will show the amount you're approved for and what to expect for a monthly payment. Next slide. The last thing to consider when buying a home, know how much you want to offer for the home. A good realtor is a key when negotiating with the seller. List any contingencies you would like to include, such as, do you need grant funds to qualify, or do you have to sell your current home in order to qualify for a new one? Do you need seller concessions or seller help to help pay towards closing costs? Is there a preferred date you want to close on? Make sure you will be available to close on this date. Moving settlement dates is frowned upon since the seller is most likely depending on the funds to close on their new home. Know the deadline to accept the offer. Lastly, please be sure to have your deposit ready to be paid upon signing the contract. I really appreciate your time and giving me a chance to briefly explain the home buying process. I'm going to pass this back over to Hawa, where she's going to cover some other key life events.
Thank you so much, Derek. So continue putting all your questions in the chat box, but also, Angela, can you